In today's video, I want to talk about short run versus long run market dynamics, and particularly how they relate to the current market environment we're in and the current market rhetoric I'm hearing and we're experiencing, and what we're going to do with it. So right now, in the short term, I'm hearing a whole lot of short-term market dynamics, and they might play out. It might play out that these short-term calls might work. For example, Mike Wilson, very accurate market analyst so far this year, saying with a Republican win tomorrow, we might get a short-term rally. I think that might be true. Sorry, my hair is being a little weird. We might get a market rally with the Republican win, but that is, in my opinion, a short-term rally to be sold and shorted. Why? Because I think the long-term dynamics are very much present and will be more important for the overall market direction in the time frame we care about. If you've been watching this channel, you know our picks and analysis doesn't necessarily revolve around a couple days. We're trying to, play the month-to-month time frame. We're looking for things that are mispriced and won't generate money on a single earnings report, but will generate money through multiple earnings reports. So, short-term dynamics, Republican win. People say, go look at historical patterns, and they say, oh, in a split government, the market tends to do well. Sometimes history helps you, and other times it doesn't. I think regardless of how the election goes, it's not a good environment for the market. If you get a Republican win, you're less likely to get stimulus. It's going to be divided government. There's not going to be anything too crazy happening, which is probably good. I'm not saying it's good or bad for the market. Probably good, just overall, just good not to have more stimulus for day-to-day life, for the long-term vision of this country, for these kinds of things. It's good for that, 100%, not to overstimulate and to bring things back. However, if you note, ever since Joe Biden won the election, and from that point until the market peak, there was just straight rally. It wasn't on anything crazy. Yeah, the economy was opening, but nothing too crazy unexpected. What it was continued stimulus, continued spending, continued liquidity. If there's a Republican win, my assumption is there's not going to be a whole lot of mega stimulus coming down the road. So I think there's actually going to be less likely that we're going to get something like the Inflation Reduction Act, etc. Less likely that we're going to have a ton of money going to Ukraine, etc. So, Republican win, maybe we get a one-day market rally. If you've been watching this channel, if you agree with me 100%, you're just not going to play that. You're just going to wait for a better pitch. We recorded the video previously about waiting for a better pitch. We're just going to stay relaxed. We're going to keep our same portfolio construction of 30% cash, 30% energy, 30% shorts, and other bets. I feel very good, very calm with this construction. Feel very good to just coast and ride with it until the environment changes. And I don't think the environment's going to change for a while. So this brings us to the long run. What are the important things in the environment? The Fed raising interest rates, the return of Austrian economics. It's not going to play out, it's not going to reverse overnight. We just went through 10 years of heavy stimulus, of easy Fed, et cetera, et cetera, et cetera. They couldn't really even do a smidge of anything without spooking people. Now they're forced to lay down the hammer, and it's spooking people. And I expect that to continue. And I think there's plenty of people out there who think, oh, the Fed's going to pause in March and the market's going to rally. And I'm not saying this is like an uncommon thing and that there's just very few people thinking this. There's a lot of people thinking this. A lot of people in the back of their heads thinking it. I even think there's some probability of it occurring. However, when it doesn't occur, and when the Fed continues to be hawkish, and as they continue to raise rates, and as they hold rates high for over a year, or roughly a year, it will cause things to come down. Real estate 6 months behind. We're going to continue to see pullbacks in real estate. Dryers are buying up. I just saw something like 37% of real estate agents can't pay rent right now. That should tell you a whole lot. That's going to affect other areas of the economy. Other areas of the economy are going to experience the same thing real estate agents are experiencing right now. In my opinion, my assumption, whether I be right or wrong, you'll be the one to judge. I guess it'll be part objective, is that there's still more pain ahead. So we have to be very smart about deploying our precious capital, because our cash is going to generate us better returns. That's part of the whole raising interest rates thing. We're going to have options. If we're 30% in cash, we can be relaxed. We can just generate returns on our cash simply because interest rates have gone up. I don't know if you've noticed that, depending on who your broker or your bank is. They're paying you a little bit more. It's still not a whole lot, but it's something. It's working in our favor. So we want to be the capital holders. We want to be well positioned. And in my opinion, that good positioning is 30% cash, 30% energy, 30% shorts and other bets, roughly a third, a third, a third. You can play with those weightings however you like. That's my opinion. That's how I'm positioned. It's generating us very good returns. And most importantly, or partially most importantly, it's giving us high levels of confidence and peace of mind, because there's nothing like high levels of volatility and stress to really make this a whole big pain in the butt, right? We want confidence, we want calm, and we want returns. And I think that portfolio construction is the way to go for some period of time until the environment changes, until it looks like, we might be ending the rate cycle. The economy might be in a deep situation. The Fed might need to stimulate, but as of right now, they're confident and comfortable with over tightening. So we should not doubt these people. We should not doubt these people. These people have absolute maximum resolve to do whatever it takes to bring down inflation, and you don't want to fight the Fed, okay? It's as simple as that. The people fighting the Fed are crying. They're crying. So that's today's video, and until next time, peace out.